Michael Burry has done what all investors merely dream of, earning millions of dollars from trading in the stock market. As the market has recently crashed, Burry predicts that an even bigger crash is coming, one that will set prices back by a couple of decades. Join us in today's video as we examine the factors that led to Burry's prediction. For the third time, Michael Burry raked in billions of dollars in 2022, following his accurate forecasts of the dot-com bubble and the economic downturn in 2008. He correctly anticipated the latest market adjustment. Despite a significant market decline, Burry thinks this is the only beginning of a much more massive drop. He still expects the market to fall by more than half from where it is now. In this video, you learn why Michael Burry is preparing for a greater recession, and how you can prepare just like Burry. Michael Burry is referred to as a broken clock by several investors because the vast majority of his wealth has been acquired through timing market crashes. Unfortunately, Burry isn't immune to the challenges of market timing. Every time he's made a prediction, he's been early, but he's also been accurate in the end. Habitually, be 1 to 2 years early on literally everything, and you too can attain broken clock status. Burry wrote on Twitter a while back. Initially, Burry predicted a market collapse in the second half of 2021. Despite the time, the situation has unfolded precisely as he anticipated. He anticipated an increase in the rate of inflation, a decline in the value of bond prices, a correction of the market as a whole, and a collapse in the growth stock market. Despite his habit of predicting very early, Burry is often correct. Human nature has helped Burry predict market crashes. The way people behave hasn't changed, even as technology has progressed, and that has been demonstrated throughout history. Third time's the charm. 10 years leading to a financial crisis. Yellow S&P 500 2000, while S&P 500 today. Green Doe 1929. Gotta love human nature. Nothing if not consistent. Burry stated on Twitter. The speculation that occurred during the dot-com bubble is represented by the yellow line. The green line is analogous to the prosperous years of the 1920s that came well before the Great Depression. In both of these periods, there was an unprecedented level of financial risk, which, in the end, resulted in a significant decline. During the height of the dot-com bubble, we witnessed non-profitable internet stocks experience gains of 1,000 or even 2,000% before tumbling to zero. In addition, there was an absurd amount of speculation during the Roaring '20s. In just 9 years, stock prices increased 4 times as much as they were. Prices were expected to continue rising, as with most investors. To prove his point, Burry tweeted a newspaper article showing how absurd the rumors were. Although the market ended the day with a loss, the headline stated that brokers were encouraged by a late-day rally. These two runs to the upside are both indicative of a single behavior, which is greed. A similar pattern of greed was observed in the years of 2020 and 2021. Burry believes the market will crash within the next 2 years, even though the market may experience a short-term recovery. Burry tweeted, after 2000, the NASDAQ had 16 bear market rallies above 10%, averaging 22.7% before bottoming down 78%. After 1929, the Dow had 10 bear market rallies over 10%, averaging 22.8% before bottoming down 89%. Although short-term rallies are expected to occur, they should not be interpreted as a sign of long-term recovery by investors, according to Burry. Dead cat bounces are the most epic. 12 of the top 20 Nasdaq one-day rallies happened during the 78% drop from 2000's top. 9 of the top 20 S&P 500 one-day rallies happened during the 86% drop from the 1929 top, he said, elaborating on his prediction. As a result of this tweet, an interesting and deceptive connection has been revealed. Consistently, the greatest market gains occur during long-term market declines, which is extremely deceptive. Burry has brought up a lot of connection between things, but we all know that a connection does not mean that something has caused it. Michael Burry has uncovered some frightening underlying fundamentals supporting his prediction. everyone is aware of how dire the macroeconomic situation is. You may hear from various economists that the situation in Ukraine and Russia is dangerously close to caving in. Others will assert that the Chinese economy is deteriorating or that the rise in US interest rates is anticipated to continue. No matter how many macroeconomic conditions are true, only one factor will bring down the economy: customers. Consumption is the primary source of economic activity. Personal consumption expenditures account for nearly 70% of total GDP in the United States. Economic collapse is inevitable if consumers lose confidence in the market. The declining purchasing power of consumers is at the heart of the modern macroeconomic challenge. If everyone stops spending and starts cutting expenses, the economy will suffer. This is the problem. Last 18 months, minus $850 billion in direct steam checks, $400 billion in cash-out refis, $1 trillion in forgivable loans with $250 to $500 billion of it fraudulent, another $4 trillion indirect, etc. What recapitalizes the consumers now? Higher wages can do that, Burry stated on Twitter. As a result of soaring prices, you and other consumers feel that your money is worth much less than it was before the economic crisis. An overwhelming amount of evidence shows consumers are at their most vulnerable in history. The University of Michigan Consumer Sentiment Index is widely regarded as the premier indicator of changes in consumer behavior. Consumer confidence is at an all-time low, as evidenced by the University of Michigan Consumer Sentiment Index, which is presently at a record low. Amazon's sales decline is yet another indication of dwindling consumer spending power. In the first quarter, Amazon's revenue increased just 7% year-on-year, and the company's first quarter revenues missed by a significant amount. Amazon has emerged as the preeminent marketplace in this age of technology, and it is there that most consumers buy the goods they need. The fact that Amazon had a poor quarterly outcome indicates that customers are in an extremely vulnerable position. And so Amazon tells the GDP, "There's your weakening consumer," Burry posted on Twitter. Given all this information, how did Burry amass so much wealth quickly? And how can others follow suit? Stick around as we discuss how investors like you may be able to do it. As a result of diminishing consumer base, Burry thinks this will reduce profit margins. The fight that companies put up to keep their prices high will be the driving force behind this. As a result, businesses will be forced to reduce their prices. However, this raises the issue of salary stability. Consequently, wages will continue to rise with regard to prices. To maintain a profit, companies will have to decrease their prices while also increasing their wages. If a decline in sales occurs, product price-to-sales ratio will drop. Shorting bonds will generate millions, if not billions of dollars for Burry's portfolio in the coming year. Later that year, he admitted to shorting treasury bonds with maturities of 30 years or less. For what it's worth, I've never shorted any cryptocurrency. This is my third bubble and the biggest. I've learned a thing or two. 30-year treasuries, on the other hand, he wrote on Twitter. Bond shorting is a no-brainer for Burry. Although yields on 30-year bonds were still hovering around 2%, inflation was quickly approaching 7%. Because of this, investors in bonds were effectively guaranteed a 5% per year loss in the short term. There is a negative relationship between bond yields and bond prices. As a result, bond yields rose and bond prices fell. Burry has previously acquired TBT, the ProShares Ultra Short 20-plus year Treasury Exchange-Traded Fund. TBT is an exchange-traded fund that engages in the short sale of a bunch of bonds. Due to the rising cost of borrowing and inflation, as well as the instability in Ukraine, bond yields have soared in recent months. As a result, bond prices plummeted while TBT soared. Since Burry first disclosed a short position, the TBT ETF has experienced growth of over 43%. Even though that is a sizable sum, Burry expects to earn far more in the long term. 1977 says hello, with a picture of him in 1977 was posted on Twitter by Burry, referring to the economic climate of the 1970s, one of the most infamous periods in world history, known as the Great Inflation. occurred from 1970 to 1980. 1977 saw a 6.5% inflation rate, which rose to about 14% in 1980. Our predicament is strikingly similar. The current rate of inflation is close to 8%, but Burry predicts that it will go up to 10% and possibly even 15%. Inflation may have already surpassed 10%. It's no secret that Burry dots the Consumer Price Index, the measure used to gauge inflation. CPI says housing costs rose 5% in the last 12 months. Wrong. CPI would be 12% using real-world NAR housing data table, which has smoothed out housing numbers forever because home prices have been a problem. So next month, they will start smoothing out vehicle prices. #problem solved. He elaborated on Twitter. According to Burry, the CPI utilizes housing prices that are significantly lower than they are. As stated by the CPI, only 5% growth has occurred in housing prices over the last year. That is a big fat lie. Using accurate housing data to calculate home values would result in a CPI inflation rate of 12%. This indicates that the current level of inflation, which stands at 8%, is incorrect by a factor of 4%. Due to this error in calculation and several other macroeconomic variables, the market is projected to witness a crash that will result in prices dropping by approximately 55% from their present levels. Burry explained on Twitter how there were paradigm shifts or speculative peaks. The S&P 500 bottomed 13% lower than 2002's bottom in 2009, 17% lower than 1998's long-term capital management crisis low in 2002, and 10% lower than 1970's low in 1975. 15% lower than the COVID low is SPX 1862, roughly Shiller P/E of 16, nominal P/E of 9, in historic range. Michael Burry is drawing attention to a trend in which the severity of market crashes tends to increase with time. S&P's crash is expected to be generally lower than COVID's if this trend holds. Burry uses a baseline of 15% here to determine whether or not this may be deemed acceptable in theory. If the S&P fell 15% below its previous record low during COVID, the index would be around 1800, approximately 55% lower than present levels. It could bring the index back to its early prices. Burry's tweet included a graph of the Shiller price-to-earnings ratio over time. The Shiller P/E ratio is periodically adjusted to provide an accurate index, implying that the inflation rate is factored in. At this point, the Shiller P/E ratio stands at 36. This ratio would be reduced to approximately 16 if there were a crash of 55%, which is comparable to the historical average. An additional graph attached by Burry shows the 12-month average of the nominal P/E ratio. Presently, our P/E ratio is 21. In the event of a 55% decline, this would drop to just 9. To put it another way, a P/E of 9 would be mildly below the average, but Burry considers it appropriate. All of the evidence supports his prediction that the suffering will continue for a while. There are some of you who believe that short-term crashes don't matter as much if you hold onto stocks for the long term. As long as you can deal with the mental anguish of seeing your portfolio fall significantly, this is absolutely the case. It's not uncommon for great companies to go through ups and downs in the short term. Amazon is a good illustration of this phenomenon during the peak of the dot-com bubble. How far can the stock of a decent growing organization fall, one destined to be one of the greatest companies in the world? Remember when Amazon fell 95%? But the Fed didn't have inflation like this hanging over its head either, Burry wondered. To be a successful stock market investor, you must be willing to stick with a stock that loses more than 95% of its value over time. Managing one's emotions in the face of a short-term volatility can be challenging for all investors. In relation to volatility, trading volume is another indicator of an impending market crash. During periods of market instability, there is typically an increase in the number of transactions carried out by buyers on both the buy and sell sides of the market. This contributes to the general trend of the increased trading volume. The ratio of current trading volume to total shares outstanding has reached an all-time low. Michael Burry emphasized on Twitter, top to bottom, Microsoft traded 5.2 times its shares outstanding by 2002, 3.3 times by 2009, and 0.5 times so far. Amazon traded 5.7 times by 2002, 6.6 by 2009, and 0.9 times so far. JP Morgan traded 3 times by 2002, 5.9 times by 2009, and about 0.7 times so far, etc. Enough takes time. There is still a long way to go before the market resembles previous crashes regarding the trading volume. This is since the market is more active when prices are down. A sizable increase in trading volume is still required for the market crash to be comparable to those that have occurred in the past. Remember that Michael Burry is not a professional in the field of finance. He runs a hedge fund and would make money if the market fell. Do your research and take risks when investing in the stock market. Nevertheless, given his record of success, I would not disregard Burry's forecasts. He recently stated, "At least I tried," in response to the fact that the traditional financial system never takes his advice into consideration. What do you think of the statements made by Michael Burry? Do you think the market will see an even bigger crash? We'd like to hear your opinion on this in the comment section below. If you enjoyed this video, kindly like and subscribe, and we'll catch you in the next one.